Welcome to this explainer. You've probably been seeing the massive media coverage everywhere about the upcoming SpaceX IPO. The rocket launches, Starlink, Elon Musk, it's undeniably an awesome story. But here's the thing about great stories. They can actually make for terrible investment theses. Today, we're taking a sober and mentor's look right past the rockets and the flashy headlines, and we're going to break down the cold, hard numbers of this initial public offering. There's this concept I like to call the IPO Excitement Trap. And honestly, right now, SpaceX is arguably the biggest example of it in history. Everyone around you is going to be screaming that this is a once-in-a-generation opportunity for the everyday American investor. But by the end of this explainer, I want to show you exactly why all that excitement might actually be the most dangerous thing about it. Okay, let's quickly pull up our roadmap for today. We're going to cover the IPO excitement trap, the retail disadvantage, what SpaceX's financial reality actually looks like, how its valuation compares to NVIDIA, and finally, my verdict on why you really shouldn't rush.
All right, Section 1, the IPO Excitement Trap. Let's dig right into understanding all this hype.
So the IPO excitement trap is kind of brilliant because it's essentially by design. An IPO is a company's absolute peak media moment. The hype is literally off the charts. And ironically, that is exactly when it's hardest to think clearly about the actual underlying business fundamentals. The psychological pressure makes it feel like an absolute can't-miss moment. Everyone is telling you, hey, this is a once-in-a-generation opportunity. But I really want to show you exactly why buying into that excitement is a trap, completely blinding you to some major risks that are just hiding right in plain sight.
Moving to Section 2, the retail disadvantage. We need to talk about how IPOs actually work behind the scenes.
Let's think about how IPOs actually function here in the US market. Studies show that on average, an IPO returns about 10 to 15% on its very first trading day. Now that sounds incredible, right? Who wouldn't want that? But here is the insider's secret. Those initial gains, they go almost entirely to institutional investors. The big Wall Street banks, the hedge funds, the massive asset managers, they get their shares allocated before the stock even officially starts trading on the open market. So by the time you, the everyday retail investor, open up your brokerage app and hit buy, you're already buying in at an inflated price. The big players get the initial pop, and you're left buying into a stock that already has sky-high expectations baked right in.
And honestly, the data proves this trap is very real. Check this out. Almost two-thirds, 66% of all IPOs fall more than 10 percentage points behind the broader market within 3 years of listing. So why does that happen? Well, because that initial price spike you bought into on day one, it already priced in years of future growth. So for the stock price just to stay flat, the company doesn't just need to perform well, it needs to not disappoint these enormous, borderline impossible expectations.
Which brings us to Section 3. Inside SpaceX's financial reality. Time to look past the shiny rockets and face the debt hammer. Consider this staggering figure, $4.94 billion. And I want to be crystal clear about what this number actually is. This isn't their revenue. This was SpaceX's net loss in 2025 alone. Just take a second and think about that. That is like lighting almost $5 billion on fire in a single 12-month period. But wait, it doesn't stop there. The cash burn has actually accelerated. In just the first quarter of 2026, SpaceX lost another $4.28 billion. Guys, that is almost matching their entire previous year's losses in just one single quarter. The financial hole they are digging is getting deeper at just an unbelievably rapid pace. So the crucial point here is what happens when you tally all of this up. This massive rate of loss leaves SpaceX with a total accumulated deficit of $41.3 billion since the company first started. That's the total amount of money they've lost. Think about it. If a company listed on your local stock exchange had a net loss of almost $5 billion last year and an accumulated deficit of over $41 billion, would you really be rushing to buy it on day one? The story has to be absolutely extraordinary to make that kind of financial sense. Now, I know exactly what some of you are thinking. You've read the bull case online. You're saying, yeah, but Starlink is profitable. And you know what? You're absolutely right. Starlink, completely in isolation, had an operating surplus of around $4.4 billion in 2025. It's a genuinely impressive business, no doubt. But here's the catch. When you buy SpaceX stock, you aren't just buying Starlink. You are absorbing the massive cash burns of the rest of their entire portfolio. You're buying XAI, which is burning cash at a massive rate. You're buying X, formerly Twitter, which is also burning cash. And you're buying their extremely heavy, expensive rocket development programs. Basically, you take the good, but you absolutely have to pay for all the bad too.
And that brings us to a highly revealing dynamic. While the media hype machine is practically screaming at everyday American investors to buy in, the insiders, they're doing the exact opposite. Insiders, including Elon Musk and early investors, are cashing out right now. We are talking about massive cash outs in US dollars occurring right at this moment of peak hype. So we really have to pause and ask ourselves a very simple, logical question here. If this is supposedly the ultimate time to buy and hold forever, why on earth are the founders and insiders selling massive amounts of their own equity right at the absolute peak?
Section 4. Let's talk valuation. SpaceX versus NVIDIA. Time for a little PE reality check. So SpaceX is expected to list at a price-to-earnings, or PE, ratio of around 250. Now, for comparison, think about NVIDIA. NVIDIA is literally one of the fastest-growing, most incredibly profitable companies on Earth right now, and it trades at a PE of around 40. With the SpaceX IPO, you'd be paying 250 times earnings for a company that is, on a net basis, losing billions and billions of dollars. Honestly, does it really make sense to buy in at an IPO during peak hype, paying that kind of absolute premium? Which leads us to Section 5, our verdict. Don't rush. We need to prioritize strategy over emotion here. Look, let me be completely fair to the bull case here. I am definitely not saying SpaceX is going to fail. The technology is very real. Starlink is a massive, totally legitimate business. And there is absolutely a version of the future where SpaceX becomes one of the most valuable companies on the planet. But trust me on this, the company isn't going anywhere anytime soon. The IPO price, however, that might drop significantly. If they actually execute their plans, if Starlink continues to scale, and if those massive billions in losses start to shrink, there's going to be a much better, much safer entry point later on, after all the IPO dust finally settles. So watch it, but don't rush it. I really want you to remember this core principle. Excitement is not a strategy. The exact psychological pressure that makes an IPO feel like an unmissable moment, the peak hype, the maximum visibility, those sky-high expectations, that is the exact formula that causes it to underperform. It's literally the mechanism designed to trap retail investors into buying at the very top. So I'm going to leave you with this final thought, just to challenge your own investment strategy before you ever hit that buy button on your brokerage app on IPO day. Are you making decisions to build real wealth based on actual fundamentals and hard numbers? Or are you just following the hype? Look at the financials, understand the mechanics of the market, and let strategy, not emotion, guide your portfolio. Thank you so much for joining me for this explainer.